Hello, I'm David Hardesty, and this is part 2 of our lecture on taxation of non-business income. We're now going to consider interest income, that is, non-business income, and which is taxed at the 30% rate. Theoretically, interest that is considered non-business income is subject to 30% tax and withholding. This taxable interest includes any interest paid on debts of a U.S. person and any unstated interest or OID on such debts. However, much of U.S. source interest income, including bank deposit interest and portfolio interest, is exempt by statute from tax. As noted in the previous slide, much U.S. source interest income is not taxable. However, some interest income is taxable. In this part of the lecture, we will first consider what income is likely to be taxable and then move on to the types of interest income that are exempt from tax. Here are the types of interest income likely to be taxable. The first is interest on an instrument issued by a corporation or partnership and received by a 10% shareholder or partner. This interest includes OID and unstated interest. For this purpose, the ownership attribution rules at Section 318 are applied but are modified by Sections 871 and 881. Contingent interest is taxable. Contingent interest includes interest determined with reference to receipts, sales, or other cash flow, profits, changes in the value of property, dividends, partnership distributions, or similar payments made by the debtor, and other types of contingent interest identified by the regulations. Interest that is taxable is interest on foreign bank loans to U.S. borrowers other than to the U.S. government, where those loans are made in the ordinary course of business. Another class of taxable interest applicable only to foreign corporations is interest received by a controlled foreign corporation from a related person. A controlled foreign corporation is generally a foreign corporation where 50% of either the total voting power of all classes of stock entitled to vote or the total value of all stock in the corporation is owned by U.S. shareholders. Here's an example of interest earned by a 10% owner of a U.S. corporation. Smith, a non-resident alien, owns 20% of Foreign Corp, a country X corporation. Foreign Corp owns 50% of the common stock of Domestic Co., a U.S. corporation. Smith buys $1 million of the registered bonds issued by Domestic Co. As discussed in a later slide, without considering Smith's indirect ownership of Domestic Co., the interest would qualify as portfolio interest that is exempt from U.S. tax. However, Smith owns by attribution 10% of Domestic Co., and the interest received from the bond is taxable in the United States. Here's an example of taxable contingent interest. Flores loans $5 million to Domestico, a U.S. corporation, for a term of 5 years at an annual rate of 1%, with additional interest payable of 9% per year if Domestico's net profits for the period of the loan increase by 20% per year. The non-contingent interest of 1% per year is subject to the portfolio interest exception discussed in a later slide. However, the 9% interest is contingent and is taxable in the United States. As noted in a previous slide, only U.S. source interest is potentially subject to tax. U.S. source interest income includes interest on the following: obligations of U.S. obligors, including the U.S. government or its agencies, debts of U.S. citizens or residents, loans to U.S. corporations and U.S. partnerships, and obligations of a foreign taxpayer if that interest is effectively connected with a U.S. trade or business of the foreign taxpayer. However, U.S. source interest does not include interest on deposits with a foreign branch of a U.S. corporation or partnership that is engaged in commercial banking activities. A major exclusion from tax on interest income is the exclusion for interest on bank deposits. Under this exclusion, interest paid to foreign persons on their deposits with a U.S. person carrying on a banking business is not subject to 30% tax or withholding. Ordinarily, this exception applies to bank deposits, deposits with domestic savings and loans, amounts paid by an insurance company under an agreement to pay interest. Note that this exclusion is not affected by the depositor's ownership of the bank. This exclusion does not apply to bank deposits that are connected to a U.S. trade or business, making the interest income effectively connected income. This effectively connected rule is discussed in the lecture on business income. Here's an example of bank deposit interest. Sinclair is a country ex-citizen and resident with $1 million deposited in Domestico, a U.S. bank. He owns 25% of the common stock of Domestico. Despite the fact that he owns stock in Domestico, he can exclude from U.S. taxable income the interest he earns on these deposits. An exception exists from taxation for short-term discounted obligations. If an original issue discount obligation has a term of 83 days or less, then the interest income on that obligation is not taxable. Portfolio interest income is excluded from the 30% tax and withholding on non-business income. Portfolio interest, which is excluded from the 30% tax and withholding, includes the following when received by a foreign person: stated and unstated interest and OID on unregistered debt obligations that are designed to pay interest only outside the United States and only to foreign persons. These are known as bearer obligations. This provision applies only to debts issued before March 19, 2012. And debt obligations issued in registered form. To qualify for the exception from tax, the holder must provide the borrower with a certification of foreign status, such as Form W-8-BEN. Here's an example of a U.S. corporation that issues registered obligations. In 2011, Domestico issues $50 million in 10-year registered bonds, paying interest at a rate of 4%. Allen, a country ex-citizen and resident, purchases bonds with a face amount of $1 million and receives interest of $40,000 per year. He provides a Form W-8-BEN indicating that he is a non-resident alien individual. Under the portfolio interest exception, the interest income will not be taxable in the United States. The taxability of foreign persons on interest income received from U.S. borrowers is affected by U.S. tax treaties. If interest received from U.S. borrowers is exempt from tax under the rules discussed in the previous slides, then it is ordinarily exempt from U.S. tax under U.S. tax treaties. As exceptions to this rule, interest income attributable to a business carried on through a permanent establishment in the United States is considered business income that is taxed as part of the business income of that permanent establishment. If the income is attributable to a independent personal services carried on through a fixed base in the United States, then the interest is business income taxed as part of the U.S. business income. A next major category of non-business income is royalties. Royalties on copyrights, patents, secret processes, trademarks, know-how, and similar intellectual property are subject to 30% tax and withholding. Such payments, when classified as royalties, are subject to tax regardless of whether they are received in periodic payments or are received as lump sums. An example of the latter is prepaid royalties. Note that payments with respect to transfers of intangibles are generally not considered royalties and are therefore not subject to withholding. However, such payments are, if such payments are contingent upon the use or productivity of the property that is purportedly sold, then the payments are recharacterized for this purpose and for treaty purposes as royalties that are subject to withholding. In addition, where less than the seller's entire rights in the property are transferred, then payments may also be recharacterized as royalty. Finally, royalties that are effectively connected with a U.S. trade or business are not subject to 30% tax and withholding. Most U.S. tax treaties exempt or reduce the tax rate on royalties when they are received and earned by foreign persons. U.S. tax treaties generally exempt a foreign person from U.S. tax on U.S. source royalty payments or reduce significantly the tax on such payments. The exemption applies to royalties for the use of any copyright of a literary, artistic, scientific, or other work, including films, any patent, trademark, design, or model, any plan, secret formula, or process, or for information concerning industrial, commercial, or scientific experience, and gain derived from the sale of this property to the extent that such gain is contingent on the productivity, use, or disposition of the property is considered a royalty. Note that the treaty exemption is not available to the extent that the royalties are attributable to a permanent establishment in the United States. Such attribution recharacterizes this income as business income for treaty purposes. Here's an example of a transaction involving intangible assets that can create royalties subject to withholding. Foreign Corp is a Country X corporation that sells a patent to Domestic Co., a U.S. corporation. The transaction involves a complete transfer of all of Foreign Corp's rights in the patent. Domestic Co. will use the patent in Product X, which it will sell in stores in the United States. The sales price of the patent is based on Product X sales over a period of 10 years. No tax treaty applies to this transaction. Because the sales price is based on the use or productivity of the patent, all payments to Foreign Corp are royalties that are subject to 30% tax and withholding. The next category of non-business income is rents. Rents received from the rental of property located in the United States are U.S. source non-business income that is subject to 30% tax and withholding so long as the rental activity is not a trade or business. However, if the rental activity is a trade or business, then the rents are effectively connected business income and the gross receipts are not subject to 30% tax or withholding. We will discuss effectively connected income in a later lecture. In addition, if rental real property is not a trade or business, the taxpayer can make an election to treat real property rental as a trade or business. The advantage of having rental real estate treated as a trade or business and the associated income as effectively connected is the taxpayer is allowed to take a deduction against the gross rents, and U.S. tax is imposed at regular marginal tax rates, not the 30% flat rate. U.S. tax treaties ordinarily characterize real property rents as business income taxable only to the extent attributable to a permanent establishment in the United States. This result should be the same as taxing the property as a U.S. trade or business under U.S. domestic tax rules. Here's an example of rental real property in the United States. Yoshino is a Country X citizen and resident who owns real property located in Chicago that she rents to an unrelated person. Her rental income is $250,000 and her expenses are $175,000. If, in the unlikely case, the activity is not treated as a trade or business, and if no tax treaty applies, then the tenant must withhold tax on gross rents of $250,000 at a rate of 30% without reduction for expenses. If, on the other hand, the rental activity is a trade or business, then no withholding is required and Yoshino pays U.S. tax at regular rates on her net income of $75,000. In addition, if the activity is not a trade or business, then she can make an election to treat it as a trade or business. Non-business income theoretically includes compensation for personal services. However, in most cases, it will be treated as trade or business income. Compensation for labor or personal services is ordinarily considered income from U.S. sources when services are performed in the United States. If such compensation is not considered wages under U.S. tax law, then it may come under the catch-all phrase of FEDAP income. And if it is U.S. source compensation income that is not trade or business income, it is subject to 30% tax and withholding. However, personal services performed in the United States constitutes a trade or business, so the income is usually effectively connected income, which is not subject to 30% tax and withholding. Here's an example of compensation for personal services. Smith is a Country X citizen and resident who provides on-site consulting services. He travels to the United States and spends 6 weeks with a client providing services. The services performed are personal services. Such services are deemed to be a trade or business within the United States. And the source of the income is United States because this is where the services are performed. As such, as we will learn in a later lecture, the compensation for services is effectively connected income, not non-business income, and is therefore not subject to 30% tax and withholding on non-business income. There's a limited exception in the code for minor personal services performed in the United States, and then there's a major exception in most U.S. tax treaties. Let us cover the minor exception first. If the requirements of the code are met, then a foreign person can exclude up to $3,000 of compensation from U.S. source income that is subject to a tax in the United States. Because the amount that can be excluded is so small, we will not cover this exclusion further. There are two major exceptions to U.S. source compensation income provided in many U.S. tax treaties. U.S. tax treaties provide that income from personal services performed in the United States is not subject to tax in the United States if, in the case of services performed by an employee, the person performing the services is not present in the United States for more than 183 days during any 12-month period. The compensation is paid by or on behalf of an employer who is not a resident of the United States. And the compensation is not borne by, or that is not an expense of, a permanent establishment in the United States. In addition, in some U.S. tax treaties, there is an exemption from U.S. tax for compensation received for independent personal services, that is, services not performed as an employee, where the services are not attributable to a fixed base regularly available to the individual in the United States. Ordinarily, capital gains and losses are not non-business income that is subject to tax and withholding at the 30% rate. U.S. source net capital gain of a foreign person is ordinarily taxable in the United States only if the non-resident alien is physically present for at least 183 days during the taxable year. Capital gain, when taxable under this provision, is not subject to withholding. Now, This rule is ordinarily inapplicable because once an alien is present in the United States for 183 days, he or she is taxed as a resident under the physical presence test. However, as we learned in previous lecture, the physical presence test for resident alien status ignores certain days of presence in the United States. And these days are not ignored for purposes of this special test for the taxability of capital gains. In addition, the test for resident alien status includes an exclusion, or an exception, where an alien has a closer connection to a tax home in another country, and this exception does not apply when determining the taxability of capital gains. So it is possible for an alien not to meet the regular physical presence test, but to meet the 183-day test under this special rule. Finally, the disposition of U.S. real property interests are ordinarily subject to tax as effectively connected income. This is discussed in a later lecture. Even if a non-resident alien is taxed on capital gain in the United States under this special rule, gains recognized before and after the person is a resident of the United States would not be taxable in the United States. This is because, as we will see later in the course, gains from sales of personal property, including stock sales, are sourced in the seller's country of residence. Here's an example of taxation of capital gains. Spicoli is a country X citizen and resident who is physically present in the United States for 175 days in 2010. During 2010, he has capital gains from sales of stock in U.S. domestic corporations. Because he was not present for at least 183 days, his gains are not taxable in the United States. Assume that instead of 175 days, he is present for 183 days and is treated as a resident alien for 2010. The special rule for capital gains does not apply because he is taxed in the United States on his worldwide income as a resident alien. Now assume that he is present for 183 days but is not considered a resident alien because he maintained a closer connection with country X for 5 of those days. He is still taxed in the United States on his capital gains because the closer connection exception does not apply when determining the taxability of capital gains. There are several other types of FEDAP income which we will not discuss here. These are pension and retirement distributions, Social Security income, scholarships and similar payments, annuities. The rules and exclusions for these types of income are discussed in the text. However, the best discussion is in IRS publication 515.